Good afternoon, folks, and welcome back to Almus Market Mornings. Now, for a change, tech errors in the age of AI is not uncommon. I uploaded the wrong podcast, and of course, we are re-recording today's podcast. So I thank JK for his time again. Broadly, moving on to markets, they have been in a holding pattern as there is limited stimulus to drive them. The general focus has been on economic data. Yesterday, a weak retail sales figure from the US kept the dollar weaker and yields subdued, while today the focus will be on the US jobs market report. Good morning, JK. What are we expecting out of today's US job market report, and can it be a market mover?
Good morning, Swaraj. Yeah, that's what the market is hoping because mostly markets have been rangy, except for a few segments which are moving, like the dollar yen and the yuan. Otherwise, the dollar index itself has been in a range. We have had some important data yesterday, that is the retail sales that was much weaker than expected. Basically, the headline number was matching last month's number, but the control group of retail sales, which is direct input into the GDP consumption calculations, was much softer, coming at minus 0.1 versus 0.4% that was expected. So now the first quarter consumption number is likely to be much softer. Um, there was an expectation GDP number was going to be very high, but now with consumption forming, two-thirds of the US GDP, this can actually have a downward impact on the GDP number. And of course, reaction to this was a drop in the yields and then also drop in the dollar in general. Not so much against euro and GBP, but more against the yen. Now, coming to today's data, which should have been ideally announced on Friday, uh, because of the temporary shutdown of the government, the data had to be rescheduled to be released today. And now the expectation is slight rise in non-farm payroll number from 50,000 to 70,000. Now, unemployment rate remaining at 4.4%. But it's interesting to hear Kevin Hassett, sorry, the economic advisor to White House, who said that job gains could be lower in the coming months due to slower labor force growth as well as higher productivity. And we all know that AI has been keeping the employers on the guard, not committing to too much, recruitments, and this is actually creating a lower job creations. We have seen a host of numbers last week, including the ADP number, JOLTS, layoffs, all of them coming much weaker. Market is looking for a confirmation of a softer employment picture in the US. And of course, to an extent, it is discounted, but much softer number would reconfirm that Fed approach may have to be reassessed, because now slowly the April cut, though it is not in the majority view, it still moved up to 36% probability from 32% probability. June, of course, is about 80+% probability of cut. So official view is also looking like, if this month's number holds up, I think overall they think that the job market is going to be softer. So that is a very important thing that to be taken note. Now, as I mentioned earlier, yen and yuan, they have been moving, on the stronger side. Yen was somewhat of a surprise because most of the market were expecting, after the Kachi's resounding win in the recent elections, yen to be weaker based on fiscal deficit increasing, consumption tax to be cut, and defense spending to be increased. But what's emerging is that the government will achieve these without increasing their debt, and that's given a lot of comfort to the market, actually reflected even in the Japanese yen yields on long-term bonds, which is now lower. For instance, the 40-year JGB, which was yielding 4% recently, has come down by about 25 to 30 basis points. It really reflects investors now buying into the Japanese bonds. And basically, when the yen bonds are being bought, there is some demand for yen that's reflected in the yen going down, rather the dollar yen going down as well. We were at 157.60 post the election, and then now we're near about 153 now. That's a 2.5% drop in the dollar yen. And a break below 152 can be quite significant and lead to much more losses for the dollar yen. It can have some impact on the other asset markets as well. So I think in this context, the job market number this today will be quite crucial. If there is a softer number and yield in US drops further, that can lead to dollar yen dropping even more from these levels. Yuan is the other one which we have been highlighting in our recent presentation, that steadily weakening dollar against the yuan. We are below 6.91 today in the morning, and the Chinese central bank has also been fixing the yuan central rate at weaker levels, and now it is at a 2.5-year low as well. So China has been, getting a lot of investments. There's some traction in the economy, patchy, of course. Some data showing good numbers as well. So, and China is also looking to show a stable and a strong currency as they look to see the benefit of diversification from dollar into the Chinese economy as well. So these are the two movers, and then GBP and Euro, of course, are sidelined. Commodity currencies have been again stronger. Aussie, but Aussie in particular has been at a multi-year high now at 71 plus. So overall, even if the job numbers come a bit stronger and you see some strength in the dollar, I would think that is going to be temporary, and we will see, eventually a dollar moving lower. In fact, yesterday the Commerce Secretary of US, Mr. Lipnick, had said that the weaker dollar is a more natural level to promote US exports and expand economic growth. He pointed to other countries using a stronger dollar or keeping their currencies weaker to promote their own exports to the US. But Mr. Trump was changing the trade dynamics. So they probably are looking to keep the dollar on the weaker side to get a higher growth through higher exports. So that's a very significant statement. You are also seen some statements from Trump earlier in the month. So overall, I feel the dollar is headed lower. And in the domestic market, for a change, we were confined to a very narrow range of 90-40 holding up, with the demand coming from PSU banks, and then modest flows. Significantly, FI numbers have been positive for the month. Market is looking whether that holds up and whether we're going to have a increased supply of dollars from FIIs, and of course, as a follow to the budget, people are also looking at whether we get FDIs, coming in a big way in the coming weeks or months, and those expectations, not yet belied, but not seen the real in reality also. So I think market is a bit on the wait and watch attitude. 90-80 offers a very strong resistance because exporters who had missed out on the big down move are looking to sell there. In case there is a squeeze in the dollar, we can see it up to 91.10, but nothing beyond that unless we have a large negative trigger. Thank you.
Thank you, JK. And of course, we have highlighted the pockets of dollar weakness that we are now witnessing, whether it's yuan or yen. Both are trading quite stronger. Even Chinese yuan fixing by the PBOC have been on the stronger side by, it's the strongest in 2.5 years. Apart from that, when it comes to our own domestic markets, rupee has been quite rangy. Somewhere, some FII flows which are seeping in, that is sort of helping rupee remain in a range and not follow through with its old path of sharp weakness. So as of now, we remain in a range. 90-40 and 90-80 are the levels to watch out for. That's it from us today. Thanks for listening. We'll catch up tomorrow with a fresh round of updates.